to another monthly Rosecut webinar. Here today with me is Daniel Greenhow, which is our portfolio manager at Rosecut. Today's topic is how to invest through a recession 2.0. We've been asked a lot by our clients about the recession, inflation, and related questions recently. So we thought it would be good to have another webinar cover this content, in addition to what we talked about in the beginning of 2020. It is a bit of an unusual time because typically you don't have recessions or volatilities in the market so often, but we had a very big market correction in 2020 March area, and now we're seeing a very unusual year in 2022 again. So 2 years ago, we covered in detail of the technicalities of how Rosecut portfolio is very different and resilient to most of the things seen in the market. So today we won't repeat that. We will instead focus on, as an individual investor, what you should be thinking about facing all these uncertainties and risks and volatilities in the market, and how to structure your affairs in the most resilient and long-term oriented way. First of all, as mentioned, I'm joined here by our portfolio manager, Daniel. And Daniel, would you like to give a quick intro of yourself?
Certainly. Hi, everyone. Thank you for dialing in. My name's Daniel. I spend my days looking at markets and making asset allocation decisions, and also decisions around what ETFs we put into portfolios for Rosecut clients. My background is in wealth management. I spent 14 years as a portfolio manager, first at a big private bank and then at a couple of smaller investment firms.
Great, thank you. Actually, I forgot to say my name to the new joiners today. I'm Chaja, or Q for short, CEO and co-founder of Rosecut. I used to work in the private banks and decided to leave and start Rosecut because I believe in the knowledge of expertise of managing one's money should be shared with a much wider audience rather than the very few, very rich. So before we start, a quick risk warning. We're talking about investment here, and investment can rise and fall, and investors may not get back the amount originally invested. So this is something we have to talk about, as per the FCA rules. But I'm going to add something, a bit of a quick twist here to say, if you hold everything in cash, there's only one possibility, is that your cash will reduce in value as inflation acts as a tax on it over time. So it slowly and gradually decreases in its purchasing power, even though the face value stay the same. But if you do invest, you have a chance of making more money, or you have a chance of losing some money, but you have a chance of beating the inflation and purchasing power. So that's usually the second piece of content that people don't necessarily bring it up during risk warnings. But anyway, then the past performance is no guarantee of future, but past performance is some indication of a team's capability of making future returns for you. So turning on to our agenda today, we will quickly talk about some, context in terms of recession, the challenges we are facing at this potential round of recession, because every time it's different, but history, does not exactly repeat itself, but rhymes. Certain times there's a lot of learnings we could have from looking at what happened in the past, and then how we are dealing with it as a professional money manager and what you should be doing. So it's a teamwork, really. The client needs to do certain things and achieve certain understanding and have the patience and commitment to get it right on their side, which really allow us to do our job. And then we're going to talk about what we are doing with it. At the end of the usual 40 minutes presentation, we will open up a poll and to show you what are the potential topics we think you might benefit. And then please do tell us what you like to hear next. And the Q&A session, please do type in your questions as you go along, so we can look at a way to structure it in the most effective way. Our colleague David here is on the line also to help with part of the questions as well. So let's jump into it.
Great, thanks, Q. So why are we talking about a recession now? Well, there's a big clue, and it's coming from the central bank in the UK, and it was in their August announcement. And here's a couple of charts I picked out from it to illustrate the point for you all. On the left-hand side is a chart where the Bank of England is effectively saying they expect negative GDP growth. In layman's terms, this means negative economic growth or recession. It's quite unusual for a central bank to say they expect a recession, and they really stand out on a global basis, because the Federal Reserve, for example, I'm not sure they could say it that honestly, but you know, Bank of England, to their credit, they have. The chart on the right-hand side also shows a particularly unusual feature for this upcoming recession, if we do indeed go into one. And that is that inflation is quite high. And although it's forecast to come down in time, that time lag means that the central bank might have to continue raising interest rates into a recession. And this is very unusual. First reason why we're talking about recession now is because the central bank is warning there is one coming. And it's not just the UK. So whilst the US, their Federal Reserve, might not be specifically saying we expect a recession, they're still believing they have a soft landing. What we see in the markets suggests something a bit different. And what we've got here on this chart, and it's a bit technical, so I'll talk you through it. The grey bars that you see coming down the screen, those are recession periods. So you can see, for example, in the early 1990s, there was a recession. In the early 2000s, after the dot-com bubble burst, there was a recession. 2008, you can see on there, and also that small grey bar in 2020. That was the COVID recession, which was a pretty quick one, hence the reason the grey bar is pretty thin. Now, the blue line, you can see how that always goes through zero just before the recession. And this is why it's such a good recessionary indicator. When that happens in the past, it's meant a recession's coming. And the track record is 9 predictions and 9 correct predictions. And what's driving that blue line is the difference between a 10-year government bond and a 3-month government bond. And the reason that's an indicator is because when the central banks are raising interest rates a lot, that means the 3-month treasury bonds go up in yield. And when they go up higher than the 10-year, it usually means there's something going wrong, and the central bank has raised interest rates to such a high level that it's going to actually stop economic growth. So we don't have to dwell for too long on the difference between the 2 points on the yield curve. The main takeaway is when this blue line goes below zero, and you can see how it's heading there now, that usually means there's a recession not long after. So far we've got the UK central bank saying there's a recession. Secondly, we've got the US bond market saying, look out, there's a recession on its way. So that's why we're talking about it now and what you can do about it.
Yeah, before we move on, Daniel, can you talk about what recession means, both for the financial market and for the real economy? Because I think these are two different things where sometimes people don't fully appreciate the timing or the impact of each.
Yeah, so there's some of that will become clear as we go along, but I think the main point to pull out is that there's a difference between the economic cycle and the market cycle. Stock markets and bond markets tend to be forward-looking. So that's why, if I go back a slide for a moment, that's why the blue line here, which is a signal from the bond market, moves ahead of the actual recession. It's because investors are looking forward, they're figuring out what's coming down the line, and it reflects their view in market prices before you actually see it in the economy.
I think this is why professional investors talked about the stock market is a leading indicator of the real economy, because when the prices of various assets or stuff in the financial market has demonstrated something that pretty much forecast what's going to come next. It's usually ahead of people's feeling the real pain of what's going to come next, or the benefit of what's going to come next if we're in a different part of the cycle. And this has important implications to how we invest, which I'll leave it to you to elaborate later on.
Great. Well, you mentioned that cycle, and that's a really important point, because what we've got on here on this slide is an idealized business cycle. And the idea is that essentially the same cycle repeats over time. You have an expansion phase, and then economic growth peaks. You go into a recessionary phase, eventually that hits its trough, and then you go back into the expansion phase, and the cycle repeats itself. So this is why when you're reading news headlines about the risk of a recession, it's always worth bearing in mind a recession is not a final thing. It's not like you stay there forever. You eventually pull out of a recession, the cycle repeats itself. And as we just touched upon, the market cycle follows a similar path. It just moves at a slightly different time, which is why it's so tricky to try and get that timing of the market correct.
I think I've read research before by the banks, I think at Credit Suisse where I was, where they talked about the average recession lasts between 9 to 18 months. The longest was 18 months, but even global financial crisis back in 2008 was only 9 months long, right? But people feels it's like longer, and it feels like it lasts forever, and it feels terrible because you might have lost your job during that time. It has much more sort of psychological impact than it really is on the just pure hard number asset based. So I think just worth mentioning it here. People make recession sounds like a monster, and we have to stop it at all price. And central banks don't typically predict that, like you said, but it's part of life.
Yeah, and it's a great point on the duration of a recession, how long that lasts, and how long the expansion phase lasts. Because what we've got on screen is an idealized business cycle, just to illustrate the point that you go in and out of these phases, but they're not of equal length. If you consider what happened in the financial crisis, so that was a recession in 2008, 2009, you then had an expansion phase which lasted all the way to 2020 when COVID hit, at least in the US for illustration purposes. So the expansion phase can last a lot longer than the recession phase. It all depends on what's going on in a wider context. This particular moment in time, it would be a bit unusual to go back into a recession just 2 years after we came out of one, but it looks like it's very possible. So let's just touch upon what a recession means. As I mentioned, going into a recession, before you get there, you have the peak in economic activity. And that tends to be when inflation pressures are high, and so the central bank starts to raise interest rates. And the reason they're doing this is to try and bring down what we call aggregate demand. So that's demand across the economy. An example of this is consumer spending. If people have to spend more on their mortgage, for example, because interest rates have gone up, then they have less money left over to go on holiday, go for nights out, etc. That reduced spending then leads to less production by companies. They have to employ less people. And so you can see how then you start going into a recessionary phase, where typically inflation starts to fall, and then the central banks change tack. They look at what's happening and they go, okay, we now need to start cutting interest rates because we know that will help stimulate growth, but it happens with a time lag. So if you cut interest rates today, some people say it'll start to take an effect in the real world in 6 months' time, but it's 6 to 18 months' time really. So the central bank has this rather difficult task of trying to time when they do interest rate cuts. If we are going into recession now, it's a particularly unusual one because the central banks are still dealing with the inflation problem that we have. And so that means they're still raising interest rates. And that means those interest rates are going to have an effect in, say, 12 months' time. There's a duration mismatch where, the help that you get in the economy from cutting interest rates might kick in after we've already got into recession, and therefore we might spend a bit longer in recession, and is ideal.
Why do you think central banks are raising interest rate knowing recession is on the horizon? Is that under political pressure that they felt like they have to help the government dealing with inflation to stay in power? Or do you think they feel this is the right approach to curb the inflation so the market can go through their own, rhythm of different cycles? Why do you think that is?
So the first thing to say is central banks have a mandate to keep inflation at a certain level. Within the UK and the US, it's 2 to 2.5%. That's viewed as the ideal inflation rate. And they have to explain themselves when inflation is either too far below this or too far above this. And it does get political, particularly in the US. There are the midterm elections in November, so we're just a couple of months away from that. And it's been a big issue. People get very unhappy when inflation's high, and you can understand why. It means that cost of living is going up. And inflation, it's different to unemployment. If unemployment goes up by 2%, that means 2% of the population are affected. With inflation, 100% of the population is affected. That's why it's such a hot topic. And we can also see from history how much social unrest it tends to cause. Nobody really likes mentioning it, but the hyperinflation that happened in Germany just prior to the Second World War was enough to make people worry about inflation getting out of hand. So that's why it's such a hot topic.
Got it.
If the inflation that we have today, it's quite a difficult thing to deal with. So there are two ways you can get inflation coming through. One is what we call supply driven, and the other is demand driven. Supply, that's caused by issues like the energy crisis. So if the price of oil is going up and the price of natural gas is going up, that then impacts on other things. So the cost of food, for example, goes up because farmers have to use oil, which is converted into diesel to power their equipment. The food distributor has to then transport that food around, so that goes up in cost. The cost of your heating bills go up. That's a particular point at present. There's also geopolitical factors playing into the supply chain as well. So when China shuts down because they're concerned about COVID, that means there's a delay in getting goods from China over to the Western economies like the US. So all of these factors cause inflation to go up. And these are factors that the central bank can't really impact. The central bank can't pump more oil and get the oil price to come down. President Biden has done his best in the US by releasing oil from their strategic petroleum reserve, and that's helped a bit. Oil prices hit $120 earlier in the year. Now they're down to about 80, depending on which contract you're looking at. But that's scheduled to end in a month or so. So the supply issues might come back in the next few months. And again, that's something that the central bank can't do anything about. What the central banks can deal with is the demand pull inflation. So this is where, if you think back to what happened during COVID, not only did you have low interest rates, you also had a lot of payouts from the government going to people. So stimulus checks, for example. The amount of stimulus pumped into the economy to deal with COVID was incredible, really. Some measures suggest that actually the US spent more fighting COVID than they did on the Marshall Plan to rebuild Europe after the Second World War. That's to put it into context. Once you've adjusted for inflation, it was more money. And the thing is, when you give people free money, they spend it. Like, that is why we saw cryptos and all the meme stocks and all the really speculative investments go so high in late 2020 and into 2021. It's because people literally had so much money they were, kind of throwing it around. There was this guy on YouTube, I won't mention his name, but he's a social media influencer. He would have a bag of letters from Scrabble, if you ever played the game, and he would literally pick out 4 letters to make a stock ticker and say, I'm going to buy that stock. No one else is done. It's just, what the heck, let's go for it. And people were following this sort of behavior. And when you get that sort of speculative behavior and that much money thrown around, then it's not a surprise you get inflation. And that's what the central banks can deal with by raising interest rates and engaging in what we call quantitative tightening. They pull liquidity out of the system. So all this free money that's been floating around starts to get reduced. And that means that demand starts to fall. People have less money to spend. That's the part of inflation they can bring down. Hope that's all making sense so far. Q, jump in if anything's unclear.
Sure. I think one thing I would say here is that we talked about how central government can impact on the demand by basically printing money one way or another, hand out to people, or quantitative easing, that's another way of printing money. People felt like from 2008, when central governments in US and UK did the QE thing, printing money, it didn't lift the consumer inflation that much. It kind of stayed at a very moderate level where it really inflated the asset prices everywhere, properties, real estate, financial markets, and all the stuff. So how is that different this time, right? Like the consumer inflation has gone up so much. And what do you think drives consumer inflation versus asset inflation in this case?
In terms of a difference, we didn't have the supply problems coming out of 2008. The oil price, for example, came down, and from around 2014, US shale production was rising rapidly, and that helped keep commodity prices low. So you didn't have that part of inflation coming through. In terms of a demand side, after 2008, what you saw was the quantitative easing and low interest rates. That really helped banks and people that had assets. And I think they were kind of hoping you had this trickle-down effect, where the wealthier got richer and they would spend more, and some of that would pass down to those that were less wealthy. But it didn't really happen. It just sort of got stuck in asset price inflation, and the main street, the ordinary consumer, they didn't really see inflation coming through as a result. And there were other factors as well that helped with inflation back then. So you still had a big move towards globalization. So that helps keep costs down because you have all this cheap labor overseas. You didn't have the sort of trade union activity that we're seeing crop up again. So that kept wages low. You had technology helping make things more efficient. So that helped. But the big one, I think, was the commodities. Having low commodity prices really helps keep inflation down.
Which is not what we have at the moment, and especially with all this ESG investment. But that's another big topic we might.
Yeah, don't get me started, Q. I will be here a long time.
Okay, let's move on to what we're doing.
Yeah. So the market looks ahead. So if the market's looking ahead to the recession phase, what does the market want to do? And how do you want to deal with this? Here are 5 options that I've put out there as things that we look at doing within portfolios. One is quite an obvious one. You keep higher cash levels than you would normally have, so that you have some, if I think about it, some money free, so that when you see the bottoming of this phase and asset prices are cheap and you're ready to get back into the market, you've got some money to deploy. That's really important. You really want to make sure you've got that money set aside and it's ready to deploy into risky assets when the time is right. I'll talk later about the difference between holding cash inside a portfolio where it's ready to invest versus outside a portfolio where it can be locked up and difficult to invest at the right time. The second point, again, relatively straightforward. You want to have low levels of equity exposure. So when I'm talking about equities, I'm talking about stocks and shares here, and particularly to cyclical industries. And what I mean by cyclical are those that are very exposed to the business cycle. So when you're going into recession, you think about a consumer discretionary stock. If people have less money to spend, the discretionary spending gets cut first. They keep on buying the staples, food, for example, they need to live, but maybe they cut back on, I don't know, expensive handbags. I know I've cut back on those for a long time, and stuff like that. Third point, you want to keep lower levels of corporate bonds than usual and higher levels of government bonds. And the reason for this is government bonds, they're unlikely to default. Somewhere like the US or the UK, they can print their own money. So if they ever did run into real problems, that should be a way out of it. It looks a little debatable right now in the UK, but a lot of that is headlines, so don't get too caught up in that. In terms of why you want to keep lower levels of corporate bonds are issued by companies. If companies are seeing economic activity drop, that makes it harder for them to service the debt, so the market price is in a higher risk there. So you want less exposure there. The fourth one is a particularly timely example, and that's dollar exposure. So people tend to look for safe havens when they think we're going into recession. And on a global basis, the dollar is still the reserve currency, and it's seen as a safe haven, and so it often rises. And we're seeing that a lot this year. It's really noticeable. And frankly, it's causing a lot of problems because a lot of emerging markets, they borrow money in US dollars. And if the dollar goes up, it makes it harder for them to service that debt. And so it causes issues there. Holding some dollar exposure within a portfolio, whether you're normally a 100% dollar investor or maybe you invest in sterling, just having a slice put aside in dollars can be really helpful. The fifth one, this is a bit different this cycle. Normally you wouldn't have too much commodity exposure going into a recession, but this time it's the commodities that are kind of causing the recession in a way because they're too high. And I'm particularly concerned that if the US does stop releasing oil from its strategic petroleum reserve in the next month or so, then that means the supply of oil is going to get tighter again. And if China opens up and stops locking down for COVID, that would bring more demand on. And so that could get the oil price moving higher again, which then feeds through to higher inflation expectations and makes it harder for the central bank to lower interest rates. So this cycle, it's slightly different, but for once, some commodities exposure going into recession might be justified.
Yeah, I was watching an interview of sustainability officer of a German asset manager. She was the whistleblower and then got fired, and how she talked about the ESG industry has managed to mobilize more than $1 trillion into the investment, but failed to move the needle on any of the environmental or social or governance objectives. What it has created is a bubble of ESG branded assets, and then that bubble has busted. So I think, it's worth pointing out here at Rosecut is that we don't appreciate the ESG trend. We think that if you want to do good for the society and environment or governance, you can do many other ways, such as taking less flights or save water, save energy, putting equal hiring practice at your business. All of this is much more effective than you putting money into so-called ESG products. Yeah, just a side comment from here. But please.
Yeah, it's a great point, Q. And ESG is a really timely subject. I get there are a lot of well-meaning people that are interested in this space. The problem is that some of the solutions that have been put forward are fundamentally flawed. And unfortunately, it's meant that what we're seeing now is because there was such underinvestment in the fossil fuel industry, but people still need those fossil fuels to maintain their standard of living. What they're now doing in places like Germany is reopening coal-fired power plants. That's terrible for the environment. Coal is one of the dirtiest fossil fuels out there. They could have kept going with the nuclear power plants, which they might have to now reopen instead of shutting down. That's one example, because nuclear doesn't produce a carbon. It involves heating water, that's it. There are other things they could have been doing, like switching to natural gas, which produces half the CO2 emissions of coal-fired power plants and is just as reliable in terms of producing electricity. There's lots of ways we could have done this differently. Unfortunately, I think people are learning the lesson the hard way, and it's driving the higher inflation we've got. Yeah, as I said, don't get me to speak about it for too long, because I could go on and on. Let's go on to an example. I talked about the US dollar and how it can help in the context of a portfolio to provide some defense. And I just want to give you an example here of how that works. The chart in front of you shows the performance of the S&P 500. This is the main US stock market indices, the 500 biggest firms in the US. If you look at its performance so far this year, or should I say to the 23rd of this month, because it was a couple of days ago I put this chart out, it was down almost 22% year to date in US dollar terms. Now, if you're sat here in the UK and you're a sterling investor, you haven't had a loss of 22%. I'll show you your loss. You're down 3%, because you see the underlying companies in the S&P are all dollar denominated. And when sterling depreciates against the dollar, it means that those US equities are worth more to you when you convert them back. So it's a bit of a wonkish concept, but think about it this way. If US equities are down 22% and sterling has depreciated against the dollar by 19%, then 22 minus 19 gives you a 3% difference. And so whilst you're still on a loss, I'm afraid, down 3% in sterling terms, it's not as big a loss as the 22% you would have had if you were hedging your dollar exposure, essentially. So this is a really important point when we have a situation like we have today where sterling's weakening. It means that, and slightly frustratingly for me, it means that having overseas equities actually helps give you diversification. And I say it's frustrating for me because we've been underweight equities because we've been worried about what's happening so far this year. So we've had less risk exposure than usual. It's not helped as much as we thought because of this dollar effect. And so we're looking at putting dollar exposure in the portfolio in a different way, potentially holding it in cash for sterling clients. So you have more of a balanced mixture of currencies throughout your portfolio. But it's a really good example of how when you look at a portfolio, there's a lot of different risk factors in there. And in a scenario like we have today, having overseas currency exposure is really helpful.
Yeah, so I think the typical Rosecard clients are pretty chilled. They understand that, by giving us money to manage, there are going to be up and downs. And something called the maximum drawdown on the portfolio means, by design, the portfolio may go down 10, 15%. That's all part of the design in exchange of potential return, right? But recently, we've got quite a few anxious inquiries from our clients to say, GBP is like sleeping at home. How does it, what does it mean for my portfolio? And by this point, we explain to people, foreign exchange rate together with another three main factors, not by itself, but asset allocation, industry, and regions. Together, these four elements drives your return. You cannot just fixate it on the FX rate alone and thinking, well, GBP is dropping, so I need to do something. Actually, by lower valued GBP, it helps to drive the revenue and therefore the share prices of a lot of FTSE 100 companies, right? So we may see this as a contribution to your gain in the portfolio rather than a detrimental thing. So one of the things I would point out here is that we look at this together with all the different forces that might have an impact on your portfolio and pick out the optimal path. So Daniel was sharing about what he would do as a professional manager of trying to express the dollar exposure in the portfolio through different ways. But which is all part of the overall strategy of having the right mix of different assets and currency exposures in the portfolio.
Now, let's be a bit more upbeat. You saw earlier, this is just part of a cycle. You have the recession phase, the market moves ahead of that, and then you have the recovery phase where we go back into expansion. And again, the market will move ahead of that as well, and I'll give you an example of that in a moment. What do we need to be thinking about when we get into the recovery phase? Well, it's kind of the inverse of what I was showing on the previous slide, but it's worth repeating just to make sure it's clear. This is when you want to be getting out of cash and into risky assets. And when I say risky, I'm really just talking about volatility here. So stocks and shares or equities, you want to be increasing that exposure. Within your equity exposure, you want to look at small caps. So this is just a way of saying smaller companies. Smaller companies tend to have a bit more growth than large companies because there's a certain point at which, if you're a large company, you just can't keep up the growth rate. you've become the economy. So you want small caps over large. Sometimes value over growth stocks. It's not as clear this time, so I've not included it on this slide, but something else to think about. Fourth, emerging market equities. Emerging markets tend to rebound faster and to a higher extent when you're coming out of a recession. And that's because they're seen as a riskier, higher growth market when compared to developed markets like the US or the UK. Fifth, high yielding corporate bonds. So if corporate bonds have underperformed in the recession phase, and that means essentially prices have gone down, it means you can get in at a better price. High yielding ones are the ones also known as junk bonds, slightly disparaging, but it's basically saying they're the lower credit quality companies. They're the ones you don't want to hold going into a recession, but when you come out, they're given a higher yield to reflect higher risk, but now's the time to buy them. So there's a few options to think about when we get to that recovery phase. In terms of timing this thing, this is a tricky bit. And I would encourage you all not to think about it as a binary decision. So you don't want to go from being 100% invested to 100% in cash and then 100% back, because that is so difficult to get right. Here's an example from 2009. The market actually bottomed in March of 2009. And then what you saw, and this is the US market shown here in US dollar terms, what you saw from March 2009 was you had this big rally which lasted for years, really up until March 2020 when COVID hit. And so March 2009 would have been the ideal time to buy. The problem is, if you're just thinking about buying at the low point in the recession, you're too late. Here's economic growth, and we've got the gray bar, which signals the recession. You can see the recession here didn't officially end until you're almost in the third quarter of 2009. So if you waited until it ended to start buying, you're already a bit late, but it's a catch. This official definition of a recession, the gray bar, is only declared 6 to 7 months after the recession has ended. So it was really closer to 2010 before the official body that determines when a recession starts and ended. It was only then they made that declaration. So if you were waiting for someone to say, the recession's over, you've got the all clear, well, if I flip back to that slide, by 2010, you'd already missed out on a fair bit of the upside. So that's the risk in trying to time your entry into the market on the basis of economic news. The two cycles do not match up. The market moves ahead of the actual economic cycle. That's why it's so tricky. And as I said, don't try and view it as a 100% in or 100% out decision. What professionals tend to do is they wait to the point that they see the market starting to recover, and then they start to gradually increase the amount of equity exposure they have as they gain more confidence in the recovery taking place. It's not a one decision on one day. That's incredibly difficult to get right. Apart from those of you that have a crystal ball, of course, you're fine.
Yeah, I would actually throw in a real example there. I think in addition to be able to have really good information on the market, financial market, as well as almost foresight on the economic conditions, which is, literally impossible. There's a real challenge is people having the greed and fear balance. Yeah, so I'm not a fan of Buffett, by the way, his investment philosophy, but one thing he was really right about being greedy when other people are fearful. And it's really difficult to do. I had a very sophisticated client by comparison to many others. During Credit Suisse times, he understood that every recession represents a 20-30% discount of the market I usually pay for. So he felt like he missed the 2008-2009 thing. So by the time he came to me in 2013, he's like, well, recession happens every 7 years. I'll just wait for 4 years and then give you money and take advantage of the 30% discount. I'm like, well, every year you get normal return from 7 to 10%. Why do you miss out that? No, I want 30% discount. So he's held his cash, through 2013 all the way until last year I checked, and not invested. And I show him, if you have invested, you've doubled your money over the last 8-9 years. And by the way, there was a sharp correction for just a month in 2020. You got your 30% discount there. Did you get in? He said, no, it was quite scary. I didn't know. So he waited 10 years for a 30% discount and he did not get in. And this is what I think you would talk about, holding the cash inside the portfolio or versus holding the cash in your own hands. That's the whole difference it makes.
Yep. So how are reverse cut portfolios positioned? Well, it's pretty much how you would imagine, given everything we've talked about so far. On the right-hand side, you'll see here a few bullet points. Cash is at a high level, so it tends to be about 25% of a portfolio. We've recently made changes, so it's actually more 30%. And we're looking at making sure if you're a sterling investor, we have some dollar cash in there as well for the currency effect that I talked about earlier. Our bonds are focused in government bonds rather than the riskier corporate bonds. And they have a short duration bias. Now, what does this mean? This essentially means that they're not very exposed to interest rate rises. So typically, if the central bank raises interest rates by 1%, a UK gilt of average length, say 10 years, would sell off by 8%. So Bank of England raises rates by 1% to fight inflation. That could mean an 8% loss on a government bond. With a shorter duration bond, there's less of that effect. You might have a 1% loss, 2% loss, but it's not 8%. Equities, they're concentrated in the large caps, so we don't have much by way of small cap exposure. And what we do have is some commodity exposure in case the oil price starts moving higher again. The energy sector and the stocks within there, which by the way are dollar denominated, they should help provide a hedge against any market weakness that comes about through the market pricing in higher inflation expectations. If you want any more detail on this, just reach out to myself or Q, and we're happy to talk you through how we're positioned in portfolios and what the individual ETFs do and so forth. Cash inside portfolio versus outside. As you just saw, we've got high cash levels within the portfolios. The reason we're doing that is because we know when markets look like they're bottoming, we will start allocating that money back to equities and corporate bonds, etc. The problem if you're holding cash outside a portfolio, particularly if you put it into one of these instruments that you lock up your money for 2 years to get a certain interest rate, those might start looking appealing to some people at present because interest rates are going up. I think there's a danger there that you lock your money up for 2 years when you need instant access to it to get it into the market. And as I touched upon earlier, it's not a case of you go all into the market at once. You might want to scale in. In other words, as you gain more confidence in the recovery, you increase your percentage in equities versus your percentage in cash. If you're an ordinary client, if you're someone who's got a day job that doesn't involve looking at the markets, you're going to have to do all the timing of this reinvestment into markets, and you're going to have to be constantly watching. Now, it's a tough ask if you've got a hectic life and other things to be doing. And that's kind of why we're here. And it's where we really add value by doing the day-to-day work, where we're watching markets and deploying cash in stages as we see the recovery taking place. And if we're any good at what we do, hopefully that timing's decent. It has been in the past, but of course, past performance, not guide to future performance and all of that. So that's an important distinction, and I'd encourage you all to think about that.
Yeah, that's a great point. And so for the next steps, if you are interested in letting Rosecap managing the money, please do feel to get in touch with us and download our new app and create your own Rosecap profile there by giving us some information on your personal circumstances and your future wishes. We would really be happy to look after you. But here, Daniel could talk about the next steps.
Yeah, and let me give you an idea of what we're looking at to judge when a market is starting to get attractive and we need to start reinvesting money into equities. What we've got here is a valuation metric, and it's the ratio of stock prices to the underlying earnings on the companies. And those earnings have been averaged over the last 10 years, so they're not as volatile and subject to the economic cycle. That ratio currently stands at 28 times. It's probably more like 27 times after yesterday. And that's a bit elevated by normal levels. So to gain a bit more confidence that valuations are attractive and they're pricing in all the bad news, we'd rather see this back towards 20 at least. And that does imply there's still a bit further to go on the downside. Now, valuations are important, but it's only one part of our asset allocation framework. And this picture is a bit busy, but let me try and explain what's going on here. What we've got is the main 6 factors we look at. So that's where we've got liquidity, inflation expectations, valuations, earnings expectations, sentiment, and technicals. What we do is we give a score to each of these factors. So from -2 to +2, +2 being that factor is supportive of global equities, i.e. meaning they're giving a buy signal. And if it's -2, it's saying, be concerned. And what we do is we sum up the scores for all of these factors. And we do this exercise on a monthly basis. And you can see how that score has been changing throughout the year. So in April, it got particularly bad. Struggling to find much good news back then. It's a bit less bad today, but it's still not great for equities. So that's why we're holding a lot less than we would normally, why we've got money in cash. And as point of reference, in 2020, all of these were positive. So that's the difference. And what we're looking at is these factors to change and get positive, and that's when we'll get more positive on equities. And that's what we do on a daily basis. We monitor what's going on to help make these decisions. So hopefully this has all helped. The key takeaways I'd like to leave you with is that yes, a recession in the US and the UK does look likely, but it's important to stay invested, admittedly in a defensive manner. You don't want to try and hide too far away from markets in cash outside a portfolio, because just remember, it's when bear markets, i.e. down markets end, that's when things get really cheap. That's when you want to make sure you can get invested. Just remember the timing is difficult, so have a plan for it. If you're a DIY investor, try and think about what you'd be looking at to get invested. If you don't think you've got the ability to do that, obviously we're here to help. Just reach out.
Great. That's super helpful summary, Daniel. So here we are sending out a poll. Please do take a look and decide which topics you would like to hear about next, as well as the feedback for today's webinar. Do you find this content helpful? Do you find it too technical or just at the right level? And how you heard about us and what would you like to hear next? This could be really helpful for us. We'll start to answer some of the questions, and don't worry that we will address everyone's questions before we finish the webinar, even if it means run over a bit. And so first of all, Chris asked about what are some ways to increase your dollar exposure?
So one way would be to buy a US equity ETF. The problem is that you get the equity exposure and the equity risk. So that's not a great option at present. The option that I prefer is either short-dated US government bonds, buy an ETF again. So that's dollar-denominated stuff. And I think an even better option would be if you can hold US dollars within your account, hold those as a cash position. If you can't do that, there are also ETFs that invest in US cash. So that's one that we're looking at on one of our custodians. And that just gives you the dollar exposure without any other risk factor in there.
Okay, so do you think people should exchange some of their GBPs into US dollars and just by themselves?
I think that's a more difficult decision than trying to time the stock market. So I wouldn't advise doing it if you're trying to almost become a currency trader. I think if you've got an overall portfolio of investments, I can understand doing it from a risk management point of view, just in case the sterling weakness becomes prolonged and has further to run. But as I say, there's a difference between trying to speculate and trying to manage risk. If you are going to do that, just be clear as to why you're doing it. If you're just trying to make a quick profit from going in and out, you're braver than me. I don't speculate on currencies.
No, so I think I totally agree with that. We keep telling clients that don't even try, don't even attempt to play with FX market. It's one of the most complicated and technical market in the financial assets category, you know, in compared to bonds or equities and all the other things. Professional traders get it wrong almost half of the time, but they have the expertise and time and dedication to try to make it work. Yeah. As an individual, what's the most important thing is to retain your purchasing power by having major currencies, and to make sure, you know, your overseas trips don't become more expensive. And you have the option of retiring overseas, outside UK or wherever your heart desires. So we are very happy to have a conversation about your lifestyle planning driven FX allocation, but we don't support anything to do with FX speculation. So the second question, how can we know that it's time to buy and recovery is starting? It has pretty much addressed, I'll just sum it up here. It's difficult for a non-professional to know what time is to buy and when the recovery is starting. Don't forget that the financial market will take off before the actual economic recovery start, because financial market is a leading indicator, and it's difficult to read into all this data sets what Daniel listed, and then make a complete model to run it. So if you say, okay, I don't want to pay for a wealth manager, I just want to do it myself, there's one way that you can do it, okay, is to buy global equities at any point of time you have spare cash and just sit on it forever, or pretty much close to forever. Even if the market drops 30%, don't blink an eye, just sit on it, okay? And then you will be happy, come out of it by the time you retire in 20, 30 years time, and looking at how much that pot of money has grown. But, you know, during very scary times like this year, just don't look at it. It's gonna be uglier than the portfolio that's been managed professionally. During each phase of crisis, the wider market is down 30, 40%. And it takes a lot of knowledge and resilience just to sit on it and without any action. A managed portfolio goes down 15, 20, or 25%. It's easier to swallow. Yeah, because we do risk management. But essentially, if you can buy and hold a portfolio for decades, you are most likely, almost guaranteed, going to be on the upside. Okay, so don't try to time the market is what I'm trying to say here. Can we expect crashing real estate market like it happened in 2009? Daniel, do you want to have a view on that?
Yeah, I do. I'm quite bearish on property. The problem is, if central banks have to keep raising interest rates because of inflation expectations, then the cost of servicing mortgages keeps on going up. And that's at the same time as people's utility bills going up. So they're already stretched. So I think this has been reflected in both stock prices in the US and the UK for the house builder stocks. I'll give you one example. I think I've mentioned it on one of our monthly market updates. But here in the UK, we have a company called Persimmon. They're a home builder. And when I look at their balance sheet, I can't see much, if any, debt. They've got healthy cash levels there. Hasn't helped. The stock is still down 50%, 57% year to date. And that is the market telling you that there's a hard time expected for the property market coming up. So if that's an observation the market's making, I'm struggling to disagree with the market on that one. I can completely understand it.
Yeah, I would add to that, property investment moves at, again, a very different cycle and different drivers from the main economy and the financial markets. First of all, financial markets includes everything. Real estate is one industry in the financial market, right? You've got builders, you've got developers, and you've got agents like Foxton and things like that. So by investing to financial markets, you actually have exposure to real estate. If you're talking about brick and mortar real estate, the cycle is different and the pricing point is very different. For example, in London, anything over £2 to £3 million worth is more driven by the international politics, like the wars or certain countries like what Ukraine and China goes through, than UK economy. When it's, you know, below 500,000 or around there, it's driven a lot by the UK economy and first-time buyers and stuff like that. And in between 500,000 and half a million to a couple of million, this is a very complex places depending on the region and depending on the product. It's very difficult to forecast. But if you are from the industry, you might be able to time the cycle in real estate, whereas in financial markets, it's pretty impossible. So that's the question to real estate. And then one more question, can you explain the pricing of your services? Is there a discount? How do usual prices of managing for ETFs affect the markup charge for Rosecard? I'll take this one. First of all, Rosecard has a very transparent pricing, 1% all-inclusive. All-inclusive means custody fees, trading fees, our management fees. So one of the biggest pain points of our industry is clients usually don't know what's their all-in fee is on an annual basis, and we make it simple by charging 1%. Now, that does not include the ETF fees, so you do pay separately for the ETF product fees, but the ETFs we use are very basic trackers because we're confident to get market return for you from allocation, which means different percentages of different ETFs, rather than paying for, you know, expensive ETFs that has some building strategy in that. So our ETF fee ratio is very low, like 0.2% a year on average or things like that. So overall, our all-inclusive cost and fee charges is about 50 to 60% discount compared to the traditional private banking industry, where you give at least £5 million to manage, or compared to affluent market, where you pay similar or even more prices to people, to DIY platforms like Hackett Langston. You pay them 2% to manage the money yourself. So I think, you know, on the fee side, there's a lot of advantage that if you choose Rosecard as a service provider. Okay, I think that's all the questions that show up today. Daniel, you seem to have done a great job. That people find your explanation very
well. I like that explanation. I mean, the other one could be that I just confuse people. If that is the case, feel free to email any questions over, and we'll see what we can do.
Great. I find it very clear, you know, hopefully the audience share the same view. So thank you very much for attending today's webinar, and we'll see you all again next week. Oh, no, sorry, next month. We run this on a monthly basis, and any suggestions or comments or wanting to become a client, please let us know. Download the app or email contact@rosecard.com. Thank you all for today, and bye for now.